Whether you're downsizing, moving to a different state, or finally buying that dream retirement home, the financial impact of those decisions can be huge. And not just in terms of what you pay for the house, but the hidden tax traps that can surprise you down the road.
This is definitely a topic that should be on the minds of most retirees or pre-retirees, especially if they're considering relocating, maybe to get closer to other family members or grandkids or things like that. This is a big step to take.
Welcome back to Retire Stronger, episode 35, the podcast where we help you retire smarter, with more confidence, and with strategies that keep you in control of your financial future. I'm John Foard, and with me is my business partner, Bill Kearney. And today we're unpacking a topic that affects just about every retiree at some point: housing. Whether you're downsizing, moving to a different state, or finally buying that dream retirement home, the financial impact of those decisions can be huge. And not just in terms of what you pay for the house, but the hidden tax traps that can surprise you down the road. Property tax rules, state income taxes, and capital gains when you sell your home. These are all areas where we've seen people make costly mistakes. The good news is that with proper planning, you can sidestep these traps and make smarter housing decisions in retirement. Bill, welcome.
John, good to be here. Yeah, this is definitely a topic that should be on the minds of most retirees or pre-retirees, especially if they're considering relocating, maybe to get closer to other family members or grandkids or things like that. This is a big step to take. So we want to make sure we go through it and provide as much info as we can here in the next few minutes. Let's start talking a little bit about property taxes, because if you've lived in different states, you certainly would be aware that not all states are created equal when it comes to property taxes. And I think it's true to say that when most people think about downsizing, John, they're focused on their lifestyle, right? On maybe creating less maintenance for themselves, or maybe looking at a single level home. Like I said, being closer to kids or grandkids, if possible. But really, property taxes can make or break the financial side of that move. Let me give you an example. So let's say that you own a $600,000 home here in our home state of North Carolina with property taxes of around 0.7%. That's about $4,200 a year. So if you downsize into a $400,000 home, say in New Jersey, where the average property tax rate is 2%, your taxes actually will go up, be around $8,000 a year on a smaller house. So that's $3,800 more a year, or $38,000 over the next 10 years. Here's another trap. States like California have Proposition 13 and other rules that cap how much of your property taxes can increase while you own your home. If you've lived in your house for 20 years, your assessed value may be far below the current market value. So when you sell and buy a new home, even if it's cheaper, your property tax bill can skyrocket because the new home gets reassessed at today's value.
Indeed, it does.
Yeah, and I mean, just a real example. We had a client couple in their late 60s who moved from their longtime California home worth about $1.2 million into a $900,000 home here in that area. And their property tax bill doubled because their old home was still assessed at $400,000 thanks to that cap. And they were shocked, right? They didn't quite understand how Prop 13 worked. So before you move, you obviously need to run the numbers. Don't assume that just because you're moving to a smaller house, that equals a smaller tax bill. Look at the millage rates. That's the rates that they use to determine your property tax bill. There can be some exemptions for seniors. And you have to see, too, if your state offers portability rules. Every state is a little bit different in how they look at property taxes. But you don't want to get surprised by a giant tax bill you weren't expecting, or a huge increase in your property taxes moving forward just because you wanted to make a lifestyle move.
Absolutely. Yeah. And then you also have, state income taxes as well, depending on where you live. If you move to a different state that has different level of state income tax, these are an additional hidden cost of relocating, right? And so let's kind of just go through that. We often hear retirees say, we're moving to Florida or Texas because there's no state income tax. That can be a smart move, but it's not the whole story. First, you have to establish domicile, which means basically proving to the IRS and your old state that you really do live in the new state that you moved to. That means changing your driver's licenses, your voter registration, and spending a minimum of at least 183 days. So that's 183 days there, moving your doctors and all these different things. You've got a lot that goes into making a big move like that. Some high tax states like New York and California are aggressive about auditing people who claim they've moved just for tax purposes. So, second, think about where your income sources are coming from. If most of your retirement income is from Social Security and say maybe Roth IRAs, then moving from North Carolina to Florida won't change much because you're not paying much in state tax anyway. But if you have large traditional IRA balances and you'll be taking big distributions, then yes, moving to a no tax state could save you tens of thousands of dollars over your retirement picture. So here's an illustration. Let's say that you're in New York with a $2 million traditional IRA, and your required minimum distributions, or RMDs, will be approximately $80,000 a year at age 73. New York state income tax at 6.8% is roughly $5,400 per year. Over 20 years of required minimum distributions, that's $108,000 in state income taxes. You move to Florida, that now becomes zero. So you just saved well over $100,000. Now, again, that's an example. But here's the catch. Florida has higher insurance costs, especially for coastal property. And property taxes in certain counties can still be rather high. So plus, if you sell your New York home, you may owe capital gains taxes before you even get to Florida. So again, don't just chase a no income tax state. Compare the entire and complete financial picture. Everything from housing costs, insurance, medical access, and of course, quality of life, right?
Yeah, absolutely, John. And for a more in-depth detail on the Roth part of your income picture, listen to episodes 1 through 34, where we talk about Roth conversions pretty much in every episode, right, John? Yeah, no, it's good advice. And I think another one that we hear a lot, John, is this true that I don't have to pay taxes when I sell my home? Is that correct?
It depends. I mean, the question is always, it depends.
Depends, right?
The answer, I should say, is always it depends.
Yeah, I mean, it can be, but only up to a point. So let's talk about that capital gains rule on selling a property, in particular, your primary residence. So the IRS gives you a $250,000 exclusion if you're single and $500,000 exclusion if you're married, filing jointly on the gain from the sale of your primary residence as long as you lived in it for 2 of the last 5 years. So, for example, if you bought your home for $300,000 and sell for $800,000, a married couple excludes $500,000 of gains and pays no tax. That's great, right? However, what if you bought in Silicon Valley 30 years ago for $200,000 and now your home is worth $2 million? That's a $1.8 million gain. So subtract the $500,000 exclusion, you still have $1.3 million of taxable capital gains. At a 15% federal rate, that's $195,000. And it could push you into the 20% bracket and trigger the 3.8% Medicare surtax. That's an extra $49,400 for a total of $244,400 in taxes just from selling your home. And for those listening at home and paying attention, that's more than you paid for the home originally. And here's the kicker. That large gain, it also counts as income for determining your Medicare IRMA surcharges, potentially increasing your Part B and Part D premiums for 2 years. This is a big deal, right? So we've seen retirees blindsided by this, thinking that downsizing would free up cash only to see a big chunk go towards Medicare premiums. So here you go.
Taxes, yeah.
Right? Plan your home sale like any other tax event. You may want to spread out the gains with a rental conversion strategy time the sale with other income years, or even explore charitable trust planning if the numbers are too large. And before you think about, well, what if I tried to sell my home and just did a rent to own type strategy? You have to be careful there, because most states have wised up to that, and they'll typically look at that as a sale transaction. It typically has to be a full 100% lease strategy with no credit being given towards a purchase for you to get outside of the capital gains part of this. So keep that part in mind. So when we talk about a rental conversion strategy, that would be more like converting your home to a rental property, not trying to sell it through a rental conversion to someone over a number of years. Make sure that clarification is clear.
Yeah, that's a very important factor, and to make sure, and I'm glad you clarified that, because if you don't plan and do that correctly, it could still cost you thousands of dollars in taxes that you would owe, and create the IRMA surtax and everything else for Medicare. So let's kind of put this all together and kind of walk through a planning framework, if you will, on how to navigate this situation effectively, Bill. So, how do we tie this all together, basically, is what I'm saying. So property taxes, state income taxes, capital gains, it's a lot to juggle. It's a lot to take into consideration. And I would tell you that there's going to be some areas where you're probably going to have to do some compromising. You're going to have to try and figure out, the good old fashioned Ben Franklin, T-chart, and line up which scenario that you're considering has the most positives versus the least negatives, and go in that direction. I mean, there's a possibility you can have it all line up to be in your favor. However, just make sure you do your homework and make sure you put a plan together. So, Bill, let's kind of go through a bit of a list here and talk through what a framework that would look like when we're working with our clients. And please, Bill, jump in anytime you like. I know some of these are some of the areas you definitely spend some time with our clients and go through in a lot of detail. So I would say number one, Bill, you would want to run the property tax math, right? You want to do the calculations on what property taxes are going to look like if you're deciding to downsize, whether it means downsizing in the same state you live in or moving to a new state. Those are things you're going to want to really pay attention to. So, and that's not only just looking at the rates, but also different exemptions, caps, and as you mentioned prior, looking at portability rules. Anything you want to kind of dive in and add in that specific area?
Yeah, I think it's a big deal just because how different so many states are. And most people just look at this and say, well, I'm downsizing, I'm moving to a smaller property, so obviously my bill is going to be less. It's just not a one-for-one trade. And certainly, as you said, before you make any movements in that area, you've got to see what those property tax rates look like. And in addition, if you want to go a step further, it would probably make sense to look at the history of the locale that you're looking at moving to and what their property tax increases have been in previous years, in the previous decade. I know here in North Carolina, it's an 8-year window as far as reevaluations are concerned. That's different in different states. So make sure you're aware of what the history of the reevaluations of property have been to give you a good idea of what you might be facing in the future.
Yeah, great point on that. And then, so I would say, moving on to this next kind of step in the framework we use with our clients would be, again, mapping out your income sources. Understand how moving to a new state, if that's what you're choosing to do, understand how that will or will not affect your retirement income taxes. Again, if your sources of income that you have are pretty much Social Security and maybe a distribution from a Roth IRA, maybe you have a traditional IRA, but you have a lower dollar amount because you've planned appropriately over time. Moving to a state with no state income tax, such as Texas or Florida as a good example, as was stated earlier, it's not necessarily going to make a huge impact on your total income tax that you're paying, especially from the state level. So However, if you have large amounts in traditional IRAs or still in your 401k plan at a previous job, or you're still currently working and you're about to retire, this could make a huge impact on your overall tax bill. But again, it's not the only thing you want to consider. It's not the only aspect you want to look at. So, Bill, I know you have a lot of advice you could possibly add and chime in on here. So I'll kick it back over to you quickly just to see if there's something you wanted to share here as well.
Yeah, I do, but I'll limit it to two things just for the interest of time here. I think you want to look at this in the sense of the tax friendly versus taxing states can also be an offset to what we said earlier. They may have higher property tax rules, but if they don't have a state income tax, that can positively affect you when it comes to your RMDs and what that looks like from that level. So you've got, like you said, you've got to take the whole picture into account on that part of it. But in addition, we used New Jersey as an example before. It's also cost of living, right? They may have a higher property tax rate. They may also have a higher cost of living adjustment up there as well, which affects how much and where you're going to have to withdraw funds. It basically will change or likely will change your overall income projection and income picture and maybe even your withdrawal order on the accounts that you already have set up. So keep all of that in mind as far as your income sources are concerned.
Yeah, absolutely. And folks, if you're out there listening and wondering why we keep bringing up states like New York, New Jersey, or California where someone might retire to, you're probably thinking, wait, why would I retire to a state like that? Why would I not retire to a place like Florida or Texas, for example? Folks, we see it all the time. Our clients retire to these places all the time for the number one reason is usually to get closer to their children and grandchildren. So this is something to certainly take into consideration. And so let's go on to the next kind of item on our list for this kind of framework we use with our clients. I won't spend too much time on this because it's pretty straightforward, but project the sale of your current property. Calculate your potential capital gains exposure before you list your home. You definitely want to know what you're getting yourself into from a tax liability standpoint on a capital gains tax situation. Know what you've got in front of you. And that kind of leads me right into the next step that we would look at or factor that we would look at. And that is, factoring in Medicare and IRMA. Don't forget that one-time income events can affect your healthcare costs. We see this on a regular basis. Bill, feel free to add in there, but I mean, it's pretty straightforward. If you have questions on these areas, for sure, definitely reach out to us. We can answer these questions. We are financial planners. We do work with individuals in these areas and making sure they're not taking the wrong steps. But feel free to chime in here.
Yeah, John, I think on the projecting the sale part, it's amazing to me how many people do not actually think about the capital gains part of the sale of their property. Many times we're focused on what is the sales price that I can achieve? What is the work that I'm going to have to do for the move? And there's not a huge part of that is dedicated towards the potential tax problem there. But keep in mind that the capital gains part of this can also be used as a negotiating tool in the sales process with the potential buyers, right? And negotiating the price. So keep that in mind. And we've mentioned IRMA, just for those who are not clear on that acronym. It's the income related monthly adjustment amount. This is the figure that is used to determine if you go over certain figures, certain areas of income, it can adjust upward your surcharges on your Medicare premiums. So you've got to factor this in as a potential cost, a potential increase in cost moving forward based on the decisions you make with your housing.
Yeah, great point. And thank you for clarifying for our listeners out there what IRMA stands for. That is certainly something that can be confusing if you're not familiar with that terminology or that acronym. I guess I would say, Bill, the last thing we always address with our clients when coming up with a good plan of action when potentially downsizing or relocating during retirement is, at the end of the day, folks, your lifestyle still matters. You want to enjoy your retirement. Taxes certainly matter. Your income certainly matters. That net take-home income every day, all day long, it always matters. But it's not the only factor. So make sure that whatever choices you're making are not just because of whatever tax-related issues that you're considering. You want to make sure that you're going to enjoy where you live and be able to have the level and the style of life that you're looking to have in retirement. So those things matter. We always factor that in. And, at the end of the day, I guess what we're trying to say here, folks, is we encourage you, and we encourage all of our clients to do what is called a housing tax kind of stress test before you make the move. Just like you would do, wouldn't buy an investment without knowing the risks. You shouldn't buy or sell a home without knowing the tax consequences. And that's really what we're boiling this down to, is you just need to do your homework, come up with a plan of action, and make sure that you understand all the factors involved before making a major change, because this is, in fact, a major change in your life.
Yeah, couldn't agree more, John. Let's wrap it up there, right? Look, guys, if you're thinking about downsizing, relocating, or buying a rental or retirement home, any sort of property changes, don't let the tax traps rob you of your money and your peace of mind. The decisions you make about housing can affect not just your cash flow, but your taxes, your healthcare costs, ultimately even your legacy. And at Crown Advisors, we help families navigate these choices with what we call a total retirement blueprint that looks at your taxes, your income, investments, and your protection all together. If you'd like to explore how these housing tax rules might impact you, give us a call today at 704-469-0200 or visit us on our website, crownadvisorgroup.com. That's crownadvisor with an O-R, group.com. And don't forget to follow us on Spotify, Apple Podcasts, Amazon Music, or watch us on YouTube. Please hit the like or subscribe button there so that you'll never miss another episode of Retire Stronger. Thanks everyone for listening today, and we'll see you next time on Retire Stronger.